Good afternoon and welcome to our webinar, Testing Your ACA Knowledge. This is kind of a part 3 of Testing Your ACA Knowledge. So thank you so much for joining us today, for taking some time out of your very busy schedule to hang out with Medcom and see what we really know and maybe what we don't know and what we can learn about the Affordable Care Act and legislation. My name is Casey Hope. I'm the Director of Marketing and Communications here at Medcom Benefit Solutions, and I really appreciate your attendance today. I do want to let you know that we are recording this presentation. We will be able to share a copy of that recording where you can go back and revisit it or listen to it at your convenience, as well as the slide deck for all attendees. We will share that after the webinar concludes. We will also have, as always, a Q&A at the end. So if some of these questions stump you and you're not really sure why, feel free to type that in the questions panel at any time, and we will address those at the end of the webinar. So today I am joined, as always, by Michelle Barki, our Senior Legal Counsel and Director of Compliance in HIPAA, as well as our ACA sales expert, Tom Neal. Michelle and Tom, I'm so glad that you are with us here today and appreciate you always taking time out to kind of share your expertise with our clients and some of our team members here. What we want to talk about today is some ACA confusion. We want to test your knowledge and give you some potential scenarios of things that we face and say, how do we handle that? What do we say? What do we do? And luckily, Michelle is here to talk about the answers to those questions. And then Tom is going to talk a little bit about how Medcom can help make that happen for you, your clients, and things like that. So Michelle, I'm going to go ahead and turn this over to you.
Well, thank you very much, Casey, and welcome everyone. And as we talk about with each of these sessions, confusion is the state of being bewildered or unclear in one's mind about something. And certainly the ACA over the years has provided us all a lot of confusion. Well, we've got 5 questions here for you today. And the first question is, your client wants to add a surcharge for those that are not fully vaccinated. The surcharge for the COVID, of course. The surcharge will follow the wellness rules and will not exceed 30% of the total cost of premiums for employee-only coverage. However, the employer recognizes that this additional cost to the unvaccinated employees will make the plan potentially unaffordable for some of them under the Affordable Care Act and under those safe harbors that the IRS has so generously given us. And several employees who are unvaccinated have rejected the offer with that surcharge. How do you advise? And the 2 choices you have is, number 1, don't do it. It's not worth the potential penalty. And the second chance is, go for it. The surcharge will not be considered in the affordability analysis. So Casey, can you launch that question poll?
I certainly will. Thank you for that, Michelle. I'm going to go ahead and launch the poll now. All right, so how do you advise your client on a surcharge for unvaccinated employees? Don't do it or go for it. So we've got don't do it, it's not worth the potential penalty, or go for it. The surcharge will not be considered in the affordability analysis. We're going to give you guys just a couple more seconds to get your answers in. We have a very strong leaning here, Michelle. Thank you to everyone who's participating. I'm going to go ahead and close the poll now and share the results. 95% said don't do it, and 5% said go for it. So how do you advise? With so many people saying don't do it, it makes you wonder, how do you handle the situation? Well, originally, when we presented this presentation, we thought you could go for it, but the agencies fooled us. There was some tricky wording in the legislation that they put out, and so the answer is don't do it. It is not worth the potential penalty. The agencies discussed the scenario where businesses could utilize their wellness program for surcharges or discounts to employee contributions for premiums if they did not exceed 30%, which is the same as the tobacco surcharge or discount for that. However, discounts are not considered in the ACA affordability scenario, and surcharges are. So there's the difference there. Discounts are not considered in ACA affordability, but surcharges are. So if you're adding a surcharge, you have to consider it in the affordability of your plan. It's a tricky situation, so we wanted to make sure that we got the right answer out there.
Okay, the second question. A new client tells you they do not have a reporting solution in place for the 2022 reporting year, which is for the 2001 tax year. They recently changed their payroll vendors and have a problem with the new vendor who won't do the ACA reporting. What do you advise? And your two options is, since the forms to the individual are not due until March of 2022, we have plenty of time to get a vendor in place. Or the second option is, forms are due to the individuals by January 31st, and it does not look like there will be an automatic extension. We must work quickly to get a vendor in place, as there is no guarantee that we can get an extension on the deadline to furnish to the individuals. And the penalty per form that is late is going to be $280 per form that is not furnished timely. So what is your best advice to your client? You have plenty of time, or forms are not due to the employee in January, or forms are due to the employee in January.
Thank you, Michelle. I think some of the questions that we have this time are a little tough, a little tricky, which is, what we want. We want to be tested here. We want to make sure that we know the ins and outs. So the question here is, what do you tell a client with a new payroll vendor that does not handle ACA reporting for the next year? Don't worry, you've got plenty of time. Or forms are due to the employees in January and you have to act now. You certainly don't want to be exposed to that $280 per form fine if they're not furnished timely. So which one is which? Just a couple of more seconds here. I'm going to go ahead and close out the poll and share the results. Michelle, 14% say don't worry about it, you've got plenty of time, and 86% say the forms are due, you have to act now. What do you say, Michelle?
I say the forms are due and you must act now. The draft forms are out. There's no indication of an automatic extension, as there has been in past forms. The other issue is that the IRS asked for 2 years straight back in 2019 and 2020 as to whether employers still needed the extension. There were some people that actually wrote in and said yes, but not enough that we don't think the IRS is going to extend. Now, what is in the draft form is that it will be $280 per form that is late. And in order to get an extension, you must write a letter. So this is, each client would have to write a letter. It must be sent before January 31st, which is the due date. It must include the filer's name, address, EIN, type of return. So you'd have to identify that you're looking for the extension on the 1095. And then statement that the extension is for providing statements to recipients. You have to give the reason for delay and a signature of the filer or authorized agent. Must be postmarked no later than January 31st. And it is not a guarantee that you're going to get that extension. So if you don't get the extension and you file after that, you don't necessarily get the $280 penalty. If it's filed within the next 30 days, it would be $50 per form. And if filed by August 1st, typically it's $100 per form. After August, it would be $280. But there will be penalties if we don't get this filed on time. So act now, make sure all your clients are set up for a vendor to get the ACA reporting done timely. The third question is, a client comes to you and says they have seasonal employees and they put them in a look-back measurement period. They stated that they received a huge contract and hired 100 seasonal employees to help get caught up, and that these employees will only work 6 months. How do you reply? Do you say, Houston, we may have a problem. Tell me a little bit more about the contract you received. Or can you say, great, you handled this right. If they do not work more than 6 months, you can consider them seasonal employees and put them in a look-back measurement period.
All right, we've launched the poll. Another great question, Michelle. So what we're looking at is an employer with 100 seasonal employees who are working only 6 months and put them in a look-back measurement period. What is your response? Houston, we may have a problem, or great job, you handled that correctly. Curious to see, right now the responses are pretty neck and neck, not the big differential that we've seen in the last 2 questions. I'm going to give a couple more seconds on getting some answers in on this one, but I do think it is a tough question, a little bit tricky. It certainly stumped me when I first read it. So great job, Michelle, on that question. I'm going to go ahead and close out the poll now and share the results. About 55% say, Houston, we may have a problem, and 45% said, great job, you handled that correctly. Pretty tight there, Michelle. What do you have to say?
Well, the answer is Houston, we may have a problem. And yes, it was a little technical because what I indicated is they got a large contract, and because of that contract, they needed to hire another 100 employees. But to be a seasonal employee, the employee must be hired into a position where the customary annual employment is 6 months or less. What the indication is, it has to be annual. So always think of that ski instructor up in the Colorado mountains, that the snow flies once a year and lasts for about 6 months, and the ski instructor comes on the job every 6 months, for 6 months every year, and it repeats annually. They got a huge contract, and they had to hire somebody, and a lot of people. The individuals were not going to work more than 6 months, but what we don't have is an indication that there was a season attached to it, and every year they're going to be hiring 100 employees. It looks like they had a contract, they needed to get caught up, but I don't have any indication that it's going to happen year after year after year around the same time. The IRS made a distinction between seasonal employees and short-term employees. If you hire somebody short-term to get caught up on a contract, it doesn't require as every season this is necessarily going to happen. They consider them short-term employees, and the IRS said they thought there was going to be a lot of abuse of short-term employees where they wouldn't be offered coverage. So they said they did not make any special rules for short-term employees, and they must be offered coverage by the 91st day. Here's the next question. And this one has come up 2 times this week or last week, so we thought we better put it in. An applicable large employer learned from a business friend that they put in a flexible contribution plan in place. Under the flex contribution plan, the employer gives each employee 15% of their monthly salary each month, and at open enrollment, they can use the money to choose from a wide range of benefits, including a choice of 3 health plans, an FSA, a DCAP, and life insurance, and whatever is left over, they can pocket. And in fact, they can pocket the whole thing. So since they have this in place, what are your thoughts? Does it affect affordability under the Affordable Care Act? And the answers are a great idea. These plans are popular because they are easy to administer, and employees get to choose benefits that best serve their household needs, or you will potentially be penalized for not offering affordable coverage if the employee pockets the money and goes to the marketplace and gets a subsidy.
All right, thank you, Michelle, for that question. So an ALE put a flex contribution plan in place, giving employees 15% of their monthly salary each month. What are your thoughts? How do you advise? Do you say this is a great idea, the plan is easy to administer, it's very popular, or there's a potential penalty for no affordable coverage if the employee pockets that money and takes that to the marketplace and gets a subsidy. I'm very, very interested in the responses that we are seeing back, Michelle. I'm going to give this poll just a couple of more seconds and close it out in just a moment. Thank you so much for participating today. It certainly makes it much more interesting when we get your feedback, and it lets us know what you need to know and how we can better serve you guys. I'm going to go ahead and close out the poll and share these results. Very heavy. 6% say, great idea, this plan is easy to administer. 94% says this is a potential penalty and it could be a problem. So Michelle, what do you say?
I say that 94% of the people got it right, and I'm really pleased to see that. Always beware of flex contributions plan. If the money can be used for any benefit that is not a medical benefit, such as a DCAP plan or life insurance, or can be pocketed, the IRS says it will not reduce the employer contribution. So employee contributions. So in fact, if you get that money and your cost of the plan is $550 for single coverage only, but they're supposed to use the monies that you give them with that 15% of salary to purchase the plan. If you can take it in cash, if you can take it on a life plan, or if you can take it on a DCAP plan, it doesn't count at all. And that $550 that they have to pay for the coverage is what the affordability is going to be based on. And that's for everyone in the plan, because everyone had that option between cash or coverage. And that means that everybody in the plan, whether they used it or not, is the affordability will be based on the amount. The only exception to this is under the McNamara-O'Hara Service Contract of the Davis-Bacon Act, which is where government employees get a bucket of money to do under a flex contribution. But because that's required by law, the IRS kind of carved them out. But for the most part, beware of flex contributions plan. And that was all explained in the IRS Notice 2015-87. We've given you the link. It answered a whole lot of questions when the ACA first came out, just before the first reporting year. And those are explained, I think, in questions 8 and 9. So here's another one. A new client comes to you and they just went over the threshold of being an applicable large employer. This year they hired 3 veterans who joined an otherwise stable staff. And because of those 3 veterans, they are now at 51 employees. So it is now December 31st, 2021. They have just gone over the 50 employee threshold mark. What is your plan? So you have 3 options this time. So you tell your client, since they averaged over 51 employees in 2001, they will be an ALE in 2022, and they must get coverage right away. Get your checkbook out, and I will call the carrier, who will typically take my calls on New Year's Eve for just such emergencies. Or come back in the new year and we'll set you up for coverage, since this is your first year as an applicable large employer. You do not need to have insurance in place until April the 1st of 2021. Or you are probably not an applicable large employer, as we do not have to count veterans who are entitled to benefits from the VA. However, come back and we will help you set up coverage after the new year if you want to insure your employees.
All right, another good one, Michelle. I think it's similar to some that we've looked at in the past, but this does add a different aspect to it with the veteran employees. So we have a client is a new ALE because they hired 3 veterans, but it's New Year's Eve. It's right at the end of the year, and it's kind of a tricky time. So you must get coverage right away, and you're calling your contacts and trying to get that set up as quickly as possible. Or don't worry, come back after New Year's. You still have time because it's your first year as an ALE. Or with the third option here, they may not be an ALE at all, depending on the veteran status and benefits offered from the VA, but still come back after New Year. We can talk about it. We can figure that out. All right, I'm going to close out the poll now. and share the results. 14% say you must get coverage right away. 57% say come back after New Year, we still have time. And 29% say, you know what, you may not be an ALE after all, but come back after New Year so that we can talk about it. Michelle, what do you say?
I say come back, you might not be an ALE. Believe it or not, the Surface Transportation and Veterans Healthcare Choice Improvement Act of 2015, just before we went into our first reporting year, provides that an employee who is covered under the VA or TRICARE will not be counted in your applicable large employer determination. They were trying to encourage people to hire veterans, and this was a benefit for that. However, once you are an ALE, they must be offered coverage like a regular employee, but you do not have to count them in when you talk about the ALE. So you can say, come back and we'll talk about getting your coverage if you want it, because you know you're getting up there in size and maybe you want to do something for your clients, but probably not an ALE if it was just the veterans throwing you off. But I really like that a lot of people realize that you did not have to offer coverage until April if they're a new ALE for that year. So that's also very good news to know that you caught that in the previous ones. So you all did a great job today. And with this, we're going to turn it over to Tom Neal.
Thank you so much, Michelle. Those were great questions. And just so everybody knows, and first, thank you for your time today, but just so you know, those are real life questions. Michelle has really hit it on the nose there. These are questions that I have gotten many times, so it's definitely something that is out there. So I'm glad that we were able to go over them. So I kind of want to talk about now solutions. As Mahatma Gandhi said, the future depends on what you do today. And that is a very true statement. It is fourth quarter. The finish line is here, and it is time. We've been talking about this for quite a few months during this ACA webinar, and we talk about ACA throughout the year, but now it is here. The deadline for Medcom to accept new 2021 ACA reporting request is October 31st. That is 2 weeks away. So if you have clients that need it or you're not sure, today is the day to find out. If you need this, please get in touch with us. We're more than happy to help, but you always want to be prepared, and you want to not only take care of your current clients, but as you're speaking to new prospects, you want to make sure that they have this in place so they don't miss out. Obviously, Medcom is more than happy to do this for you. It is not just about the data, and as Michelle has shown us in these questions, there's a lot of gray area, and it takes an expert human to look at it and make these determinations, and we have those experts in place to do it. So you definitely want to make sure you have the right solution in place. Medcom's ACA portfolio has a myriad of options for you to help with any kind of situation. Obviously, we have our full service ACA employer reporting. We also have our full service ACA FTE or full-time equivalent tracking. I always say on this service, this is for those seasonal or variable hour employees. We had a question on it today. This is a service that if you need it, you really need it. Michelle, and you can counter if I'm wrong here, but every time I have seen where we've gotten an employer that has these types of employees and they've gotten an IRS penalty letter, it's because these weren't tracked correctly. They weren't watched and put into the system right, and that's usually where the problem comes. So if you have a client that has those types of employees, they absolutely need that FTE tracking. We also have our penalty appeal support. Our penalty appeal team has, as I've said before, we're well over $50 million in proposed penalties that we've been able to mitigate. The IRS is getting more aggressive on this. As I like to say, the IRS is becoming the IRS. I mean, everybody always reverts back to their natural personality, and the IRS has spent many years chasing after tax money. So they've kind of gotten comfortable with the ACA, and they seem to be going after it like they would for back taxes. We also offer our ACA back filings. This is for those clients that missed a year, or especially a new prospect didn't really realize they need to file. And we can do those back years for them. Not many vendors offer this, but I do need to let you know we are past that deadline. That was October 1st, and our teams are now focused solely on 2021, but we still can take this request on these types of clients when we would begin working on them. As soon as we get done with our 2021 filing, we would immediately pick these back up and get them done for you. We also offer consulting and strategic evaluations. This is for those clients that need an expert to kind of bounce some questions off or kind of stand over their shoulder to make sure things are done right. We can certainly talk about that. And then finally, we have our brand new ACA Connect. This is our web-based system that gives both you and your employers a central location so that they can see everything, especially in this day and age where many of us are working hours that are nowhere close to the old 9-to-5 schedule. This gives you an access that you not only can look at your employers, see where they are in the process to know if they're getting done or not, set up meetings with the dedicated account managers without having to go through a call back and forth to see if they're available. It just gives you a lot more tools and makes them easier to do so that you can always work with us in that full service solution. And to kind of give you the idea of that full service solution, the first and foremost is a dedicated account manager. Every client, no matter their size, when they sign up with Medcom, gets a dedicated account manager that will be with them throughout the process. That account manager is going to set up a strategic call. They're going to go over what's required, the specifics of that specific employee or employer, so we know what their challenges, how their data is set, so that we make sure that we're handling it correctly for them. We'll set up a data portal that makes it easy for them to drag and drop files into it. And all the data, we're very easy. We'll take it in any format and multiple sources as long as it's in a live format so that we can work with it. No PDF, but we will take that, we will put it in the format we need to do the service. We're also going to do an analysis. We have our proprietary system that will run through everything, looking for outliers, but more importantly, we'll also have the eyes of a human expert to review that to make sure everything is correct. We will do the validations, choosing safe harbor or harbors. We'll also do the coding on the 1095Cs, and as Michelle can attest, in many cases, an employee, there may be several codes that would work, but we have the experience and knowledge to know that some of those codes are ones that make the IRS pull out the magnifying glass and look a little closer. And the idea here is to get this done correctly, fill out, all the requirements of the Act without causing a deeper review. We will also provide a model notice. This is simply a 1095C that's blank that gives instructions on what each of the boxes on that form are. That way, if you have a client that's never filed before, they can pass those out to their employees so they understand what they're getting. Once we're done, we're going to put all that those 1095Cs in a PDF format back in that secure portal, along with a cheat sheet telling you what we did and why we did it. At the end of the day, the employer is responsible for the filing, so we want to make sure they understand what we did and agree with it. Once they do that, they will give us the green light. We will then take those forms, we will print them out, we will mail them to everyone that was eligible to receive one. Anything gets pushed back, we're going to work with the client until we get them out correctly. At that point, we're then going to e-file them with the IRS's proprietary system, the AIR system. There's always going to be pushback from that system. We are experienced on how to use it, and we'll make sure all of that is submitted correctly, and we're not done until that is finished. And we receive the receipt from the IRS basically stating X number of forms were submitted on this date. We will take all of that and keep that in that portal that we set up for the client, so in case they are ever audited, they have an easy, readily available place to get that information. And as with all of our products, the idea here is to make sure that we're providing tools for our broker partners so that they can go out and increase their business, their market share, while also retaining their current clients. And we do that not only with ACA, but with our expertise in CDHP, COBRA and premium billing administration, our HIPAA and privacy security solutions, our healthcare compliance and actuarial solutions. Again, you are our clients, and we want to make sure that we give you the tools so that you can succeed.
Tom's contact information, his email is up on the screen. Please reach out to him at any time about your questions about ACA reporting or any of the other ACA services that we offer. But if you have questions about anything else that Medcom provides, our COBRA coverage, our consumer-driven health plans, our health and welfare compliance, or HIPAA, Tom can also point you in the right direction for that, or you can reach out to me or Michelle. We're all happy to answer your questions about that. Excellent job with the poll questions today, both for Michelle and those who answered the questions. They were excellent, and we got some really great feedback. Thank you again for joining us. We certainly appreciate you being here, your attention, and your trust. And we will be back in touch about our next webinar topic. But if you have any ideas in the meantime, please let me know. We're happy, to address some of the things that you guys would really like for us to do. Have a wonderful rest of the week and enjoy your lovely weekend. Thank you again for being here today.